Hey, it's Carolyn Grimm with Accounting How To. I am here with my sidekick, Terrence, and today we are going to talk about standard costing, and we're going to use Terrence's favorite food, pizza. Join me. So when we're talking about standard costs, what we're doing is we are predetermining what we think is going to happen with our costs. How much is it going to cost us to make a pizza? How long does it take to make a pizza? And we're going to figure out how much it costs us for one pizza and then multiply that out by however many pizzas Terrence can eat, which is a lot. And we're going to use this information for planning and control. So this is going to help us to make a profit in the business, for example. Now, why are we going to use standard costs? We're going to use it to measure performance. Here's what we think we're going to do. Here's what we actually did. And is there a difference between those two things? And it will help us to control costs because we're going to understand exactly how much it costs to add mushrooms to our pizza. And it's also going to help us with budgeting. One of the great things with managerial accounting is it helps us to understand where profit comes from. And when you understand where profit comes from, you can make more of it. It's a pretty useful tool. Now, when we're collecting costs in managerial accounting, we're talking about three different areas. We're talking about direct materials, dough, sauce, cheese, direct labor, the pizza maker, and factory or manufacturing overhead. This is the indirect materials, indirect labor, and miscellaneous costs like rent and insurance. So the first thing we want to look at is direct materials and direct labor. And for those two items, we want to figure out a standard quantity. How many ounces of sauce does it take us to make our pizza? And the price. What does it cost us to buy 2 ounces of sauce? And then for labor, we want to know how long it takes us to make a pizza and then how much that costs us for our labor rate. So let's take a look at our pizza. So for direct materials, those ingredients that we need to actually make the pizza, we've got 1 unit of dough per pizza at $1.50 per unit. We've got 4 ounces of sauce at 50 cents per ounce, so $2 per unit. We've got 8 ounces of cheese at 75 cents per ounce, or $6 per unit. That's our most expensive ingredient. And 2 ounces of mushrooms at 25 cents per ounce, 50 cents per unit. I know that Terrence is really big on mushrooms because he's a fun guy. Remember, I don't charge you extra for the humor. So our direct materials, we're going to total all of those up, and it's going to give us $10 per unit. So every time we make a pizza, we're going to spend $10 on our ingredients. And then let's talk about the labor. So we are estimating that it's going to cost us $12 per hour, and it takes 10 minutes per pizza. So we're estimating that it takes 10 minutes to make a pizza, and the rate that we are currently paying is $12 per hour. So we're going to take 10 minutes over 60 minutes to come up with the portion of an hour that it takes in order to make a pizza. So 0.167 hours times $12 per hour. So it costs us in direct labor $2 per pizza. So we've got our direct materials and our direct labor. Now we need to talk about our factory or manufacturing overhead. So we've got two pieces here. We've got variable overhead and we've got fixed overhead. Variable overhead is the overhead that varies based on how many pizzas we're going to bake. So the more pizzas that we bake, the more electricity that we're going to use, the more pizza boxes that we're going to need. And we want to look at our fixed overhead, which would be things like rent and insurance, costs that don't change based on how many pizzas we make. Our rent is going to be the same amount whether we make 1,000,000 pizzas or 0 pizzas. So let's break down how we're going to figure out that overhead piece of it. We're going to take our variable overhead. In this case, we're going to use our cost of electricity, and we're going to allocate the cost of electricity to each one of our pizzas. We're going to use direct labor minutes as our method for allocating our electricity costs. So we're saying it's going to take 10 cents per direct labor minute for us to make a pizza. So it takes 10 minutes per pizza. So we're going to take our 0.10 per direct labor minute times 10 minutes. So $1 per pizza is what it's going to cost us in electricity. And then for our fixed overhead, we're going to use our rent as an example. So it costs us $1,000 per rent. We are expecting that we will do 1,000 pizzas per month. So that ends up being $1 per pizza. We're going to take our cost divided by our number of expected pizzas that we're going to make. So now for our factory overhead, we've got variable costs of $1 and we've got fixed costs also of $1. So when we bring all of those costs together, now we've got direct materials at $10 per pizza, direct labor is $2, factory overhead $1, fixed overhead is $1. We're going to add all of those costs together, and we now know that it costs us $14 per pizza. So now we know that in order to break even on our pizzas, we need to charge at least $14 per pizza. So this gives us our standard costs. And now we need to look at our standard quantity. So we know that for our direct materials, we need 1 unit of dough. We need 4 ounces of sauce, 8 ounces of cheese, 2 ounces of mushrooms. Those are our standard quantities for direct materials. And we need 10 minutes per pizza for our direct labor quantity. Now that we have those numbers, what we're going to do is we're going to compare those to what actually happens. So we want to see if there's a variance between those two. And most of the time there will be at least some level of variance. We want to take what we thought was going to happen, our standard, and we're going to compare it to what actually happened. And then we want to see whether that difference, that variance, is favorable or unfavorable. So we might use more cheese than we expected because we let Terrence make his own pizza. Never do that. So our standard quantity and our actual quantity and the amount of cheese we thought we were going to use compared to the amount that we actually used. Or we could have a situation where we thought cheese was going to cost this much and it cost a lot more. So that's an unfavorable variance. Or we could find that we've got the speediest pizza maker in the world and it takes them like 5 minutes to make a pizza instead of 10 minutes. So that's a favorable variance. So when we're looking at variances, we're going to look at both materials price and materials quantity, and we're going to look at labor rate and efficiency. So we got that 5-minute pizza maker. We're very, very efficient at making pizzas. We've got Terrence in there bumbling around and it takes him an hour and he destroys the kitchen, then our efficiency would not be good. So standard costing helps us to understand what it costs us to make one of our products. And then we can multiply that out. Let's say instead of making 1,000 pizzas, we look at a scenario where we only make 800 or a scenario where we make 1,200. And we can use that basic information about what it costs per unit to come up with some what-if scenarios. What if we let Terrence into the kitchen? What happens? What if we keep him out of the kitchen? The place runs a lot better. So standard costing is a really important tool that can be used both for a manufacturing company or it could be used for a service business as well. So it helps us to get really clear about our costs and then set some benchmarks so that we can say, are we doing well or not so well? So I hope you found that helpful. I will see you in the next video.